Ever placed a trade and price reversed immediately? It is not bad luck, it is bad entry. Today, I want to show you how to flip the odds with a simple, powerful limit order strategy that works like magic when combined with price action. You don't need to chase the market anymore. Let the market come to you. This one simple strategy made me realize that I don't need to stare at my screen looking at the chart all day. I let the market do the work and it starts hitting my entries like a magnet. Here is the crazy part. This is what the pros do that no one talks about. My name is Juliet and this is Finspoke channel where we break down trading in its simplest form. If you are watching me for the first time, kindly hit the subscribe button and click the notification bell. And if you have been following without subscribing, please kindly support this channel by subscribing to this channel. Don't forget to like this video. Let's get into it. In this concept, we are looking for a higher high, higher low, that is uptrend market, or a lower high, lower low, downtrend market. We don't want to see a sideways market like this. We want to stay away with this type of market. We don't want to see a sideways market. The reason we are looking for uptrend market or downtrend market is that anytime market is trending or market is moving for a long period of time, we use it to validate if the market is trending up or trending down. We find the market break out from this range, from this consolidation to the upside or to the downside, just like this. And when this happens, the market begins a new journey or a new trend. For instance, if it breaks out of this consolidation to the upside, it becomes uptrend, and when it breaks to the downside, it starts a journey to the downside. Once this happens, it is fine to look for a trade at the break of this consolidation, either to the upside or to the downside. But what you want to see is the market create a retest after the break. The market break out of this consolidation to the upside, it will give you a retest. It breaks to the upside, come back to retest and move. The market breaks to the downside, come back to retest and move. This is what you want to see at the downside. So once you identify the break of a structure here, or the break of the structure this place, you want to take a trade. It is only at this point that you will be looking for a trade at the break of the structure, if it is pushing to the upside, or at the break of the structure if it is pushing to the downside. Now these two scenarios is what reflects the trend. These two scenarios here is what reflects the trend. Now this is the idea. Once you identify the market trending down, you are simply looking to place a level where the market has previously broken the lower low. And in the case of the uptrend, you are also looking for a place where the market has broken the higher high. Once you identify this, you now revert to a simple break and retest where you want the market to pull back to retest. Once you identify this, you revert to a simple break and retest where you want the market to pull back to retest. Then you go ahead and place your buy limit in the case of an uptrend and a sell limit in the case of a downtrend. You don't want to place a buy limit or a sell limit during the phase of consolidation. You must allow a breakout. Let price break out of that range and they come back to retest before you place your order. The difference is this: you are not looking for any confirmation in using this concept. You are simply waiting for price to pull back to a key level. Tap into that level so you set your order. So you want price to break from this zone with a momentum pressure, then pull back for a retest. You place your order. For a downtrend, you want to set a sell limit order, and for an uptrend, you want to set a buy limit order. This is just a simple concept you must understand. One thing you must note again is that when using this strategy, is that when price break out, it must break out with a strong pressure. In the case of a downtrend, price must break out with a sell pressure or a momentum candle to the downside. And in the case of an uptrend, price must break out or a momentum candle and close above or the level, close above the level. Sorry. If price did not break out with a strong momentum candle, avoid setting a sell or buy limit order. Don't use this strategy. The simple reason behind this is that higher time frame could be doing one or two things. Now, breaking above a structure in the lower time frame with a strong pressure indicates higher time frame bullish candle in the case of an uptrend. And if the structure is being broken or if the level is being broken with a sell pressure, it indicates a higher time frame bearish candles. Once it breaks, what happens at the higher time frame is that the new candle will retrace at around 50% of the previous candle, and at this stage create a wick. Once this wick is formed, then the market continues in its direction. If in the case of uptrend, the market continues to move up, and in the case of the downtrend, the market continues to move down. The thing behind this is that higher time frame could be doing one or two things. Now, breaking above that level, breaking strong above that structure indicates higher time frame bullish candle. And the breaking strong to the low indicates higher time frame bearish candle, just as you can see. Once it breaks what happens at the higher time frame is that the new candle will retrace at around 50%. Now, this is the level. The candle broke the level and the close above. Then the candle will retrace, the next candle will retrace to about 50%. Then before it moves, sometimes you see it something like this. Sometimes you see something like this. In most cases, you see something like this. So it retraced to about 50% of this candle and it starts moving. Now, sometimes you can see a small bearish candle, but then this is a confirmation that this price is continuing to the upside. The same way in a lower time frame, price broke this level and it closed below. The next candle will retrace to about 50% of this one and continue moving to the downside. At the start of the candle, after creating a wick, that is where you want to set your limit order at the 50% of the higher time frame previous candle, anticipating the market to come back to activate your order and then continue in the direction. That is the concept. You need to go for a minimum 1:2 risk to reward ratio. But personally, I prefer minimum 1:3 risk to reward ratio and above. Your stop loss should be above the previous lower high for a downtrend and below the previous higher low for an uptrend. It's that simple. Let's look at one or two examples as an evidence of this strategy. All right, in this our example, you can see price ranging around this zone, a kind of consolidation. Then there is a break with a momentum candle to the upside. Already, this is an uptrend market. This is Euro JPY. There's this forceful break out of this range, this momentum candle that break this level or broke this structure. Now, what this concept is saying is that once this happens, understand the fact that this forms a higher time frame candle, bullish candle. That's why you see this kind of pressure. So it will come back to retest at least 50% of this candlestick before it starts moving up. What you need to do is to place your limit, your buy limit order at this level. When price come to retest this level or this zone where it broke out from, it will definitely pick your order or activate it. So this is what we are talking about. And when you want to do this, you want to see minimum 1:3 risk to reward ratio in this kind of trade. Minimum 1:3 is doable. I'm not too good with 1:2 risk to reward. So you want to see a break of structure, you want to see a consolidation, you want to see a trending market, not a chubby market. This is a very powerful concept with a high probability win rate. Try it out, first backtest it, and then try it out with your demo, then apply it in your real account. Make sure you do the backtesting to see how it works before using it. You identify your strong key levels, you see a break of structure, you want to see a trending market, you want to see a momentum candle that breaks the level or breaks the structure, closing above or below, depending on the trend. Always go for a minimum 1:2 risk to reward ratio. But personally, 1:3 risk to reward ratio is ideal for me. But you do what resonates with you. Enjoy this strategy. Let me know what you think in the comment section. And after backtesting it, and if it works out for you, also come back and let me know what you feel in the comment section. Don't forget to subscribe, like, refer, recommend, and share this video. I will see you next time.